In my last video, I talked about what might happen to the market in 2022. As soon as that video went live, I started getting messages about when's going to be the right time to buy. 2021 saw a huge increase in house prices. However, in December, we also saw the first interest rate rise. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel I share with you my 15 years of property investing experience to ultimately help you get further faster in your own property investing journey. When it comes to making a decision on when's going to be the right time to buy property, the first question that I would ultimately ask is, what is it are you trying to achieve? For example, are you trying to buy a home? Is it income you're trying to build from property? Maybe what you're trying to do is get longer term capital growth, or maybe you're flipping or developing. Let's talk about all four of those now. If I was looking to purchase a home right now, I'd be thinking about where's the right location that I want to buy. Is it the kind of property I can see myself living in for the next few years? Am I going to be comfortable here? Or am I going to be able to create the home that I ultimately want with this particular house or flat that I'm looking to purchase? When you think about it in that way, it's a slightly different approach that one that my property investors will typically take, because what they're doing, they're looking at the numbers, how they're going to make a profit, how long they might need to hold the property for to be able to get the return, what's going to be the cost of finance. And yes, although some of these things are important, but a home is a slightly different approach to a traditional property investment. Now, at the moment, we've seen the first rise of interest rates start to happen. Now, that's an indication that rates are going to rise, but it's still, the cost of finance is exceptionally low right now. And if you're purchasing a home, even if you're buying property right now, which might feel quite high, personally, I would be purchasing right now because you could lock in the lowest possible rates in terms of finance for that property. Now, here's a mistake sometimes people make. They will overstretch themselves in terms of affordability. This happened quite a lot pre-credit crunch last time. So 2004, 5, 6, you saw people really stretching themselves in terms of what they can afford to buy property-wise. And then when there's a change in the market or change of circumstances, people will really struggle. So if you're purchasing a home, I think affordability is key. You don't really look at it in the same way that you would as an investment property. And yes, of course, we all like a little bit of a deal. We want to be able to buy something where we think we've saved a little bit of money. And if you're purchasing a home, and hey, if you've got an Asian background, the first thing you're looking at, how big is the extension I can put on this house that I'm going to purchase? So your alternative may be you continue renting for a period of time, trying to wait for that right house to come along so you can get it at the best possible price. But if you're doing that and house prices keep rising, just think about how much rent that you're paying that's going to be dead money versus that could be paying down a mortgage that you've got on a property that you're purchasing. Before we talk about the second type of property purchase, which is income based, if you're enjoying this content, it will really help me out if you hit that like button and subscribe to the channel. The second type of purchase may be an income-based purchase. What I mean by an income-based purchase is a property that you're buying that's going to generate you some kind of income. For example, that could be a traditional buy-to-let property where it's just let out to a family, or it could be something which is going to generate you much more higher cash flow, like a HMO or service accommodation. Now, when we're looking at properties like that, we're looking to keep them for a period of time, generally a long period of time, for it to be generating an income for us. Here, the purchase price is of course important. However, what's more important is the fundamentals, such as the location, the demand for the type of people you want to let to. Those are the key factors that are going to drive whether this is going to work for you, more so than what the current price is of that property right now. So for instance, one of our core part of our portfolio is good quality high-end HMOs in Birmingham. And when we're looking for those properties, what we're looking for first and foremost is the location. Is it in the right location that's going to work? It's going to attract the type of tenants that we're looking for, where we want to create a premium product and we want to charge a premium rent. That's the first thing we're looking for. Secondly, we're looking for, is it the right size of building? Are we going to be able to convert it to what we want? Our spend typically might be £100,000 to £130,000 to take a regular house and convert it into a high-end HMO. So we want to make sure the volume is there for us to be able to create what we want. And thirdly is going to be the numbers, to make sure the numbers stack. So we're purchasing at the right price, we're going to spend the right amount of money that we want on it, still going to create some equity on it, because ultimately what we want to do, we want to refinance that property, extract as much money out of it as we can and be able to go again. And some people call that BRRR strategy, but ultimately what you're doing, you're building a portfolio of property that you keep that's generating a really good income and trying to recycle some of that equity moving on to other properties. Now, as I said, the third part of that is buying at the right price. So would you go and buy now, or do you wait until you're going to get a better deal? Is the market going to crash? Are you going to buy at a lower point? That's really, in my belief, is it's not so relevant, because if the numbers still work regardless of the price. And when I look at HMOs I've been involved in over the last 11 years in Birmingham, the price have changed completely to what they were at that point to what they are today in terms of purchase price of a typical, say, 3-story Victorian in the right location. Those prices have changed immensely. However, we've still got the model to work, because all the other factors still work, i.e. what the rent is that we're going to be able to generate. So when we're looking for income-based property, the third item on the list is going to be the price. So as long as everything still stacks, yes, you should absolutely be buying. The third type of purchase that we might be looking at is one where we're looking for capital growth. Now with capital growth, ultimately what we're talking about is purchasing a property with over time, the value of that property will go up. Now there's no guarantee that will happen. In fact, we just hope it will go up, but hope isn't a great strategy. However, when we look at historic data, we can see house prices typically just go up and up over time. And that's essentially why as property investors will buy property and hold it for the long term, because we think it's a great investment in terms of the overall return we'll get from that. Now the house prices might rise generally in the market when all the market rises, as what's been happening over 2021. Or alternatively, you could look for specific things that might happen that may push up the value of that property. So for instance, it might be there's infrastructure investments, it could be new shopping centres being built, it could be new transport links are being put in place, or even new housing developments. All these things will generally push up and lift the values in that particular area. Now, when we're looking for property like that, what we're looking for is things that may not necessarily have happened. So for example, a new train link hasn't yet happened, but there's talks of it could happen. A new train station could be opening up, transport links are going to become easier, new shopping centres coming up in the next few years. When we look at those things, we can see over the next few years that those benefits are going to be in place and the house price will start to rise. So when we're looking at house prices today, really we're taking a much more longer view. So yes, they might be a little bit more than what they were a few months ago. And are we going to wait to see if there's a crash and we might buy a bargain? The other thing that we are looking for when we're looking for capital growth is where there might be up and coming areas that are not already starting to move. So for example, it might be an area right now that's really nice, prices are already really rising very quickly, but there'd be some of the surrounding areas or the peripheries as I call them. What will happen in those areas is they become the next best areas. And in those particular locations, you find over time price will start to rise quicker as well because they're very close by to the nicest areas. When you think about it in that way, and when you take this longer term plan, and when you're buying for capital growth, it is always a good time to be buying. You've just got to get your locations absolutely right. The fourth type of purchase you might do is where you're flipping a property or you're developing a property. Now with this particular strategy, you have to be a little bit more careful in terms of getting the timing right for the purchase, because your lead time being able to exit that project will vary. For instance, it could be a property that you're purchasing, you're going to do a quick renovation on it, within 3-4 months it's back up for sale in the market. Or alternatively, it could be that you're going to be buying a site and you're building a house out of the ground. It could be 2 years by the time you sold and exit out of that particular project. Because the lead times vary so much, you don't exactly know what's going to be the state of the market at the point of your exit, because there is still uncertainty in the market right now. We don't know exactly what's going to happen, and the last year has shown us that things can change very, very quickly. None of us can predict exactly what's going to happen. So when we're planning a strategy where we're going to exit in 3 months, 6 months time, a year, 12 months, even longer maybe, what we have to remember is we're taking an element of risk because the market could be very different from what we're expecting right now. So let's say there's a crash that happens in the market. Let's say the prices fall 20%, 25%. A lot of developers will generally work to about a 25% profit margin. Now, when we look at it that way, if the prices fell about 25%, ultimately it means you won't lose money, but you won't have made any money for all your efforts. It may be you've still got a little bit of a loss that you incur, but generally you can come out of it. Not the best position to be in, because in this particular market is a little bit more risky, but your margins are more higher as well. Of course, with developing property right now, we also have to bear in mind that the cost of materials and labor has been rising significantly over the last few months. Now, this may ease off in the coming months, but we don't really know. Again, because of these uncertainties, when it comes to buying property to develop and sell, we have to be much more careful in terms of that timing. What I would say is, as long as there's a sufficient profit margin, you're working on 25, 30% plus, which can sometimes not be easy to find those deals in this market. But if you work to that kind of buffer and dismissing most deals, as we won't work on a slimmer margin. That way, if there is a turn in the market, you're still going to be protected and you're not going to lose a shirt in your back. Essentially, what I'm saying is, regardless of which of the 4 strategies you're using, whether you're purchasing a home, whether you're purchasing a property for income, or whether you're purchasing a property where you want capital growth, or even if you're flipping or developing, the key thing that you have to get right is making sure that all the other things stack up and work for you, and it's always going to be a right time to buy. When we look at some of the facts and figures that people are producing, some of the research that's been done over the last few weeks in terms of what could happen with property pricing in 2022, many of them are talking about price price rising between say 3 and 7% over 2022. So the longer you leave it, the more you might be paying for that property. So remember, there's never a bad time to buy property. The important thing is the numbers have got to stack and work for you. Hey, if you enjoyed this video, then you're really going to like the one that I've got lined up over here for you, which is my previous forecast of what's going to happen to the property market in 2022. And also, because it's in a playlist, you'll see the previous forecasts I also made as well. So just before you do that, make sure you click on my face down here to subscribe, and look forward to seeing you on this video over here.